Good morning, everybody. My name is Cody Wilbert from URL Insurance Group. For those of you who don't know us, URL is a full-service IMO out of Harrisburg, Pennsylvania. I say full service because we offer life, health, annuities, Medicare, and employee benefits. So our goal is to always be a one-stop shop for you and your client when you come to us and work with us. One of the things I really wanted to focus on to end the year or bring the year kind of roundabout back half here is to start talking about some of these product profiles for some of our top companies and really start to show off some of the products, the features, and some of the bigger hype that we're getting from some of these companies on their product lines and what's out there and what's best for you right now. So these should be short. We're looking at about 15, 20 minutes for most of these pre-recorded webinars that you're seeing. We'll also be sure to attach resources at the end from URL and American Equity as well. So please make sure you're tapping into those, looking at those. There's a lot of great stuff we'll include as well on tap with the webinar here. I also want to introduce American Equity. That's who we're going to start with today for our product profile. Anthony Rayetta from American Equity. He is their regional sales manager for PA, West Virginia, Ohio, and Kentucky. So Anthony, thank you so much for coming on today, man, and really bringing some light to some of these products here at American Equity.
All right, sounds good. Well, my pleasure to be here. And thank you so much, Cody. And yes, Cody mentioned, name is Anthony. I also go by AJ, so whatever you prefer. But I am American Equity's regional consultant. So in my role, I work with all appointed agents in Pennsylvania, Ohio, Kentucky, and West Virginia. One of the things that I'll do after Cody and I wrap up, I will send over some supporting materials, but I will also include a regional map. So if you do reside outside of any of those 4 states, you will have the information from my counterpart over there. But really to start, so with American Equity, as an organization, we keep things very simple. All we do is fixed and fixed index annuities. And in terms of our fixed index annuity lineup, where we've been seeing most of the momentum is with our accumulation product called Asset Shield and with our lifetime income fixed index annuity called Income Shield. So where I'm going to start is on the accumulation side of things with Asset Shield. So for clients that might be looking for growth or potentially legacy, but are fearful of volatility and want to make sure that they're not losing anything, then the Asset Shield strategy might be worth considering. And we have 2 different options of it. One has a 10% premium bonus and the other does not. And in terms of what the differences are going to be, with the 10% premium bonus version, the client's going to have the certainty of getting that 10% bump to their account value. With the other one, the caps and the par rates are going to be a little bit higher. So generally, the version with the bonus is going to make the most sense for clients that might be in an existing annuity where they're still within the surrender period. And let's say they purchased it 4 or 5 years ago, what have you, and they had elected a living benefit rider, but life changed, their financial situation changed. They no longer need that income. And they're just looking to do something different. So if that existing contract is still within the surrender period, that 10% bonus from a suitability standpoint may be able to get them back above water and may be a feasible option for them. So kind of camp number 1, those clients with existing annuities with riders that they no longer intend to use. Or maybe they're presently in an accumulation annuity and the renewal rates have been absolutely horrendous. And the caps and par rates over here, in addition to that 10% premium bonus, may be able to help them and put them in a better position moving forward. So camp number 1, those clients with existing annuities where either their financial situation changed or the renewal rates are unfavorable. But even clients with new money where they just might like the idea of getting that 10% premium bonus, that might be worth considering as well. So I'm going to do a screen share really quick to highlight the differences in the par rates and the cap rates on the bonus and the non-bonus version, just so you get an idea of it. And after the call, like I said, I'm going to send Cody over the information to send you via email. So you should have everything at your disposal. So let me take a look here, entire screen. All right, and Cody, just want to confirm, are you able to see my screen?
Oh yeah, absolutely. It looks great.
Okay, great. So right here in front of me, we have the rate sheet for the Asset Shield Bonus 10. You'll see up here reflected 10% premium bonus on all first year premiums. So in terms of some of the more popular options or more utilized options, down here we have a current fixed value rate of 3%. So even if a client went 100% into that allocation day one, they get the 10% bonus. At the end of the year, they would get +3. So basically, their end of year return year one effectively would be 13%. A couple of the other more popular options right here, we have our S&P 500 annual point-to-point cap. Presently, that is 7.75%. And then we do have a few different proprietary index options as well. The one that I'll quickly highlight, just because it's been getting a lot of momentum as of late, is this first one, the BlackRock Adaptive US Equity 7% Index Annual Point-to-Point with a participation rate. That 7% is a volatility target, and the participation rate on it is 105%. So at the end of the anniversary year, if the index was positive, the client's going to get whatever the index did plus 5%. And the reason why this one has been gaining a lot of momentum is because the equity component in it is the S&P 500. So it's under BlackRock, and the equity component is the iShares S&P 500 ETF. And then there is since we have that volatility target, a portion of it's either going to be in fixed income or interest-bearing cash. But in a fixed income environment like we're in right now, where interest rates are rising, the portion that's invested in the safe bucket, if you will, is only in interest-bearing cash. So as of yesterday, I think roughly 70% of the allocation was in the iShares S&P 500 ETF, and the remaining approximate 30% is in interest-bearing cash, just because with the rising interest rate environment, the bond component could potentially put the client subject to loss. So that's how this algorithm is working on a daily basis. So that is one that may be worth considering for you.
I think another nice thing, Anthony, not to interrupt you, is just how many different diversification options you have with this product. You know, a lot of times you might see the S&P 500 and maybe one other option that's out there. You're looking at 6 or 7 different allocations for this product. And I think that's fantastic when you're talking to clients about the S&P market and also some of the other markets that are out there. And to Anthony's point, ones that are a little bit more volatility controlled. So you can have that conversation with them as well to let them know that, you know, some of these things are controlled and it's not just open to the S&P and what happens a year from now on this date. You know, there are some components in there, as Anthony alluded to, that are going to kind of put a little more fixed assets out there or protect you a little bit more in that. So it's a very nice option that's out there for them for sure.
Absolutely. That's a great point, Cody. And the one thing I always say, whether we're talking about money invested in a brokerage account, a traditional IRA, a TD Ameritrade, or even a fixed index annuity, I still think diversification is important. So these are all of the different options that you would have at your disposal.
Awesome.
Okay. So as I mentioned, this is the Asset Shield bonus version. Real quickly flipping over to the Asset Shield non-bonus version, we'll talk about what the differences are. All right, so with this one, the fixed rate is going to be 4% versus the 3% that we talked about on the bonus version. The S&P annual point-to-point cap is 10% versus the 7.75% that we saw in the bonus version.
Nice.
And then this BlackRock index that we talked about, the participation rate is 140% versus the 105% that we talked about on the bonus version. So as I mentioned previously, for those clients that might be in existing annuities with surrenders, or for clients that might like the certainty of having that 10% premium bonus, that's probably the direction that you want to go. But for clients with new money that may want to have higher upside potential, the non-bonus version may be worth considering, just because, well, it wouldn't be guaranteed, but since they do have the higher upside potential at the end of that 10-year term, or even year over year, just by having that higher participation rate or cap rate, that means that their upside is that much greater.
One thing that jumps out to me too, AJ, from that form, especially, is that's a fantastic minimum rate I see there off to the right side as well too that you guys have.
Oh yeah. And I'm very glad you brought that up. So a nice thing about the Asset Shield suite overall, so whether we're talking about the bonus or non-bonus, the contract has no fees, no additional riders. Really, the intent of it is, for pure accumulation. And once that term is over, we're fully aware that the client's either going to 1035 it into a different annuity, whether it's with or not with American Equity, or take the money and do something else. But since it doesn't have a fee attached to it, similar to a lot of annuities out there, our minimum guaranteed surrender value is 87.5%, but the minimum guaranteed interest rate is 2.95%. So just to clarify things, if a client puts in $100,000, immediately their minimum guaranteed surrender value is that 87.5%. But that 87.5% of their original premium is going to grow by 2.95% compounded annually. And what that means, if we ran into a situation where the client was 100% invested in index options and they didn't get anything credited throughout the life of their contract, with that 2.95% minimum guaranteed interest rate, by year 5, they're basically going to be at break even. So if they put $100,000 in, at the end of year 5, their minimum guaranteed surrender value is going to be around $101,000. So if they wanted to walk away at that point in time, they could and effectively break even. But even if they stay the full 10 years and they've gotten no credit on their account value, just given the way that their investment options have performed, meaning all negative, then at the end of the 10-year period, if they started with $100,000, their ending account value or guaranteed minimum surrender value would be $117,500. So obviously, we don't want anyone to run in that situation, but the silver lining there would be is if you were fully invested in index options and got zeros across the board through the entire 10-year period, by year 5, you're break even. And by year 10, if you started with $100,000, there would be roughly $17,000 of gain that you would walk away with.
Great. Thank you for that explanation. That was excellent. And I think a lot of times, like you said, it's not ideal for something to fall into that. But 3-4 years ago, we're talking about industry wide, that thing was sitting at 1% for a lot of companies. So it's a nice piece to kind of bring up or have that backing, in case the market is wonky or in case your indexing options do not return you something. It's just a nice peace of mind. When I saw that immediately, I was like, wow, that's a really, really good rate. So I didn't mean to interrupt you. I just wanted to call that out because I thought that was really good. So thank you for that explanation.
Yeah, absolutely. And I really appreciate you bringing it up. So before we pivot over to the income side of things, one of the pieces that I think does a good job of highlighting how Asset Shield would work for a client over time is this flyer right here that I'm pulling up called Preservation and Accumulation. So what we do in this chart, the red line represents the S&P 500 going back to 2001. The light blue line represents a 4% fixed strategy. And then this is looking at the Asset Shield 10 non-bonus version. And the darker blue line represents a 10% cap rate tracking the S&P 500. So the red line, obviously, we see, 2000, 2001, the first couple of years, it's negative. And then we kind of see the recovery versus a vehicle like a fixed index annuity where the client, obviously in negative years, they're not receiving anything. But they do have the peace of mind of the 100% downside protection, but then being able to get up to 10% in any year where the market was positive. So in this specific situation, I want to preface it by saying that this is a non-guaranteed return, assuming that the 10% cap rate was renewed the entire life of this situation. But just from an illustrative perspective, it helps demonstrate to clients that when the market is negative, you're protected on the downside, and when it is positive, you're able to participate in the gains, in this case of the S&P, up to 10%. Okay. So I just feel like this is a piece that's always helpful to demonstrate the potential value of a fixed index annuity for accumulation. Okay. So that's going to conclude our conversation about Asset Shield. And again, for those clients that are looking for pure accumulation or legacy, but still want to have the peace of mind of the downside protection, this might be worth considering. So now switching gears, we're going to talk about Income Shield. And Cody, just want to make sure that my screen is still shared. You see that all right?
Yep, it looks great.
Okay, great. So Income Shield is going to be for your clients that are looking for guaranteed lifetime income. And even though it's not in the name here, the product name is Income Shield 10, similar to the Asset Shield bonus version, this does come with a 10% premium bonus as well. So client puts in $100,000 day one, their account value and their income base or benefit base would be $110,000. In terms of the lifetime income benefit rider options that we have available, there are 5 total. So we have a free version, which is option 1, but as of late, the most popular options that I've seen being utilized are option 4 and option 5. So option 4 is going to make the most sense for clients that are going to be deferring income for 7 years or less. During that deferral period, their lifetime income benefit rider step up is going to be 8.25% simple interest. This is going to be guaranteed for a 7-year period. And this option also has what we call a well-being benefit. And the way that works is there would be a 2-year wait from policy issue. But if the annuitant on the contract became in a situation where they were unable to perform 2 of the 6 activities of daily living, this is going to be a doubler on whatever their payout factor is when they become eligible for this benefit. And I'll talk a little bit more about that on the next page. So we do have option 2 up here is basically identical to option 4. It just doesn't include the well-being benefit. The rider fee on the version without the well-being benefit is 1.1% versus an additional 10 basis points to elect it with that well-being benefit rider. Okay. And if we do run into a situation where a client's going to be deferring for longer than 7 years, then this option 5 is going to be the better option from a guaranteed step up standpoint. So this has a 7% compound interest versus 8.25% simple. So 7% compound, that's guaranteed over a 10-year period. And if the client wanted to continue to defer beyond that, they would get a 4% guaranteed minimum step up from years 11 to 15. Okay.
And what are we looking at for the rate for that one, AJ?
Yeah. So in terms of what the payout factors would be, obviously these lifetime income benefit rider options are what the client's going to elect, and then they're going to defer for a period of time. But now we'll get to the fun part, which is the payout factors.
Nice.
So for a 65-year-old, whether they elect option 2, 3, 4, or 5, any of the versions that have the fee associated with it, a 65-year-old individual annuitant would have a 6.6% payout factor for life. And even if we did joint annuitants, where the youngest one was at least 65, it would be a 6.03 payout for life.
Very strong.
Mm-hmm. And a couple of things that I'll mention that are unique about Income Shield compared to some of the other strategies that are available. Our benefit base is going to be growing on a daily basis. So we actually have an illustration that's called a pivot illustration, where we could reflect what the benefit base is going to be on a monthly basis. So rather than a client saying to themselves, oh, I'm going to have to wait until month 13, or, if I want to get the next step up, I'm going to have to wait until month 25. They're not going to have to do that with ours. With that pivot illustration, if they say, oh, I think I'm going to need income in about 18 months, rather than having to wait until an entire next year to, get that next available step up, where the benefit base is going to be growing on a daily basis with ours, which is really nice. So that's kind of, unique thing number 1. Unique thing number 2, let's say we're doing a contract, it's qualified money, husband is the owner and the annuitant on the contract, and the wife is the beneficiary. let's say before the income was started, the husband passes away. With our contract, the wife is going to be able to do spousal continuation, the benefit base, whatever it was at the time of the husband's death, she'll be able to retain that. And then when she decides to start taking lifetime income, obviously it's going to be based on her age, but that benefit base would not be at a loss if she elects that spousal continuation.
AJ, question for you. As far as the joint versus the single, are they allowed to elect that at time they want to take income versus application time? Because I know a lot of times that's kind of a pain point, is folks are like, I don't really know what I'm going to need at that time or what I'm going to do. Is that an option that they have at time once the policy is issued?
Yep. So that was getting to point number 3. So we already talked about the benefit base increasing on a daily basis. We talked about if husband is owner and annuitant and he passes away and wife is the beneficiary, that she's going to be able to retain everything about the policy. And then point number 3, let's say we ran that same situation. Husband's the owner and the annuitant, wife is the beneficiary. They sign the paperwork today. Oh, I think it's going to be about 4 years before we want to start taking income. But feasibly, I'm not sure if I want to be an individual annuitant or if I want to name my wife as a joint annuitant. So that's something at time of income election in the future. That's when the client's going to have to make that decision, rather than being pressured to choose single versus joint at time of policy issue.
Great, thank you.
Make sense? Okay. So yeah, in a nutshell, those are the features. We do have a free rider version as well. The difference, so option 2 through 5, there would be a 1-year wait before clients can start taking income. With option 1, clients would be able to elect income within 30 days. There is a 4% compound on the income account value that's guaranteed for a 15-year period. But what you'll see here is that the lifetime income payout factor is going to be substantially less. So if we look at that 65-year-old again, if we do the fee version, lifetime income benefit rider 2 through 5, it's going to be 6.6%. But if we do the free rider version, it's going to be 5.13%. Okay. So that is Income Shield. I will send over a brochure. But Cody, one of the things that I did want to touch on for the good of the group as well, depending on how folks are addressing that income gap conversation with their clients, whether it be a worksheet, whether it be, what number would you like to have? A few weeks ago, we created a free tool called the Income Gap Calculator. I will send you over the direct link. But if someone wanted to get to it from our website, all they're going to do is go to american-equity.com. And then, well, we're actually getting a curveball. We updated our website. Okay, here it is though. So from american-equity.com, if we hover over annuities and then fixed index annuities, if we click right here and go to the Shield Suite, since this is specific to the Income Shield, we're going to click into the Income Shield option, Income Now and for Life, the Income Shield series. And then up on the top right is where we have the Income Gap Calculator. And since this is intended to be client facing, step number 1, we talk about what guaranteed lifetime income is, Social Security, pensions, or an annuity from a life insurance company. And then if we go down here, we can actually make it specific to a client situation. So let's say we're working with someone that's born in January 1965. They want to retire at 65, and presently they're making $65,000 per year. And the nice thing about this is if they're retired, you could put 0 in there as well. Next question right here, if they're anticipating raises throughout the remainder of their working years, you could factor that in as well. And then if they were anticipating taking single or joint lifetime income, you could choose that as well. But then we hit continue right here. So based on the Bureau of Labor Statistics, for an American making $65,000 per year, on average, their monthly expenses are that $4,146. The nice thing about this tool is you or the client can customize it to their unique situation. So if you were to click on calculate expenses right here, we break expenses into 3 different categories. Category number 1 is going to be essential. So this is things like rent, mortgage, housing insurance. If we go down a little bit further, you're going to see something like a home improvement, which we categorize as essential lifestyle. And then the last category is going to be nice to have, things like vacation, so travel, lodging as an example right there. So we can get as granular as the client wants to based on their unique circumstances. But we'll stick with that 4,146. And then during where they are right now versus the amount of years to retire, they can put an inflation factor in. We have a few different options here. We'll just stick with 3.25%. And then by the time this individual wants to retire at 65, their anticipated monthly expenses with that inflation adjustment are $5,186. And then based on the Bureau of Labor Statistics data, you'll see we have this pyramid. Of the expenses, $3,200 roughly are what we deem to be essential. $1,100 are the essential lifestyle, and then $726 on a monthly basis would be what we consider to be nice to haves. So then this next section right here, this is where you're going to be able to put in their already anticipated guaranteed sources of income. So right now, based on the client's age and their income, our expectation is that they'll receive $1,982 from Social Security. If you click on the info box right here, though, our call to action is to go to the Social Security website. So you can get, you can drill down exactly what that individual client is going to anticipate to receive. If the client does have a pension, you can factor that in right there as well. Or if they have any other income annuities, you can factor that number in into this section as well. But then if we hit continue right here, when they want to retire, adjusted for that inflation, we're anticipating total expenses of $5,100 per month, roughly. They have that guaranteed stream of income from Social Security of roughly $1,900. So that means that their guaranteed income gap is roughly $3,200.
Nice.
So now if we go to this next page, this is showing us, with the help of the Income Shield product, the amount of premium that would be required to solve for each of the different categories, the essential versus the essential lifestyle versus the nice to haves. So right here, if the client just wanted to solve for the essential expenses, which are anticipated to be $1,200 per month of income, that would require a premium of roughly $132,000 or $133,000. If they wanted to solve for the essential plus the essential lifestyle, that would be monthly income of almost $2,500, which would require a premium today of almost $255,000. And then if they wanted to solve for all 3, the essential plus the essential lifestyle plus the nice to haves, that's monthly income of roughly $3,200, which would be $33,000 of premium. So you would be able to click on one of these radio buttons. Let's say that we got into a situation where that $132,000 based on a client's financial situation might not be achievable, but they still wanted to be able to solve for a portion of it. Right here, you can click on custom premium. So if the client might be comfortable with doing $100,000, let's say, you can plug that in right there, and we see that $100,000 will get them to $971. Or if you wanted to play with the numbers a little bit more to get as close as you could to $1,000 of monthly guaranteed lifetime income, you could do that as well. But we'll stick with the essential option right here. We hit continue. And the nice thing about it is you can create a PDF report with the client's name, with your information, and click on print report. And that'll put together a nice PDF that you can print off and hand to the client and say, based on our discussion, you were born January 1965. You're currently making $65,000. You don't anticipate any raises throughout the remainder of your working years. Then it goes through the pyramid that we talked about, the income gap analysis that we talked about, and then down here, a premium of $132,000 roughly would get you to the basic need expenses of $1,285. So I feel like, in essence, this is a really nice tool if you're not working with any type of income planning software, to get them open the idea of drilling down their financial scenario and then showing them what a potential solution might be.
Yeah, what an awesome tool, man. Thank you for sharing that. I mean, these are things that you can go out and use that make you that much more effective at an appointment and really give them valuable material for them to take home, as AJ mentioned, and kind of review and look at a little bit more. So that's fantastic, man. Thank you so much for sharing that.
Absolutely. All right, so there's the stop sharing button right there. Let me get back to the browser. But like I said, Cody, what I'll do, oh, there we are. Okay, I can see again. What I'll do, the information that we went over, the brochures, the rate sheets, the income gap calculator, and then the regional map for anyone that's listening that's not in the 4 states that I cover, Pennsylvania, Ohio, Kentucky, and West Virginia. I will get that over to you. So if there are any questions for folks in my state, feel free to reach out. Even if not, if, just given specifically what I talked about, if you have any questions, you can feel free to reach out, and depending on where the conversation goes, I can make an introduction to whoever my counterpart might be, depending on where you're based.
Sure. Well, awesome, man. And thank you again for joining us. I always appreciate the knowledge that you provide. It's always very clear and concise. And I appreciate, again, kind of showing us that tool as well, too, because to me, it's always important when you're on these things to get some type of takeaway of a sales tool or some type of sales item that you can use. And that's a fantastic tool, totally customizable for you to use. And again, client facing. So it's even better that you're right there. You customize it with them. It keeps that continual talk going about what they want, what they need. You get more objectives from them. And really, you provide them with something good as a take home. To further go into that and keep in mind, like AJ said, he's going to have materials provided there. We're also going to have a few URL documents to provide you. One of them is a recommendation form. This is a good fact-finding tool as well. If you have a paper version or want to take that with you or just have it printed out, please have that along with as well too. But again, use these tools and these things that are out there. This is a great company providing asset growth and income growth, giving you 2 great options to be in front of someone. And let's face it, most of the time when we're in front of folks, that's what we're discussing. We're talking about a way that you can either grab accumulation or a way that we can provide you guaranteed paychecks for the rest of your life. So great tools, great products from American Equity. AJ, thank you again for your time. I greatly appreciate it, man. And yes, I'll be reaching out to folks, but thank you for everybody joining. I appreciate it, and take care. Happy selling.
All right, great, Cody. Well, really appreciate the opportunity. I'll have that information here shortly. And again, if anyone has questions, feel free to reach out.
For sure. Take care, AJ. Thanks again, man.
All right, thanks. I'll see you.
Thank you.